Welcome to the deep dive. Today we're tackling a set of really sharp tools used in trading analysis, all stemming from Brian Shannon's book, Maximum Trading Games with Anchored VWAP, the perfect combination of price, time, volume. We're going to get right into how these can help you, understand the market better.
Exactly. We're going to explore the volume-weighted average price, or VWAP, and its more adaptable cousin, the Anchored VWAP, or AVWAP. These aren't just like abstract ideas. They're practical ways to see what's really going on with price action.
Okay, let's unpack this. So VWAP. The book lays it out as the cumulative average price a stock trades at throughout a single day. It's like finding the average price where all the shares exchanged hands during that trading session.
Right. Think of it this way. For every trade that happens, you multiply the price by the number of shares. You do that for all the trades in a day, add up those values, and then divide by the total number of shares traded that day. That gives you the VWAP, a picture of the average price where the bulk of trading occurred.
Okay. Now, here's where it gets really interesting. That's where Anchored VWAP comes into play. What's the core difference that makes it so, dynamic?
The key innovation is the anchor. While traditional VWAP resets every single morning with the market open, AVWAP lets you choose a specific starting point on the chart. That anchor could be the beginning of a week, after a big news event like an earnings report, or even a significant high or low in price. It's all about picking a point that you believe is, meaningful.
So it's way more tailored to what you're looking at, right? The book makes a great point showing how even two VWAP lines, if you start calculating one just a couple of hours after the market opens, can end up looking quite different by the close. That really hammers home how crucial that starting point is.
Absolutely. And Brian Shannon, the author, he really emphasizes how this flexibility makes AVWAP a valuable tool for everyone. Whether you're a day trader watching every tick or a longer-term investor making moves over weeks and months, he even mentions right up front how AVWAP became his go-to technical analysis method.
Yeah, the book makes the case that AVWAP can give you a sense of who's truly calling the shots in the market at any given moment. How does it do that?
Well, it boils down to the relationship between the price of the asset in the AVWAP line itself. The book suggests that if the price consistently stays above a rising AVWAP, it indicates sustained buying interest at increasing average prices. This suggests genuine demand, not just fleeting rallies.
Okay.
Conversely, if the price is consistently below a declining AVWAP, it implies that sellers are in control, with selling pressure keeping the average transaction price heading downwards. You can, see this illustrated in the book.
That makes sense. If buyers are actively pushing the price above the average, they're sort of showing their hand.
Exactly.
So when you're trying to decide between using regular VWAP and AVWAP, the book clearly steers you towards the anchored version because you can customize it to the specific situation you're analyzing.
Precisely. While the standard daily VWAP does have its place, AVWAP's ability to be customized to specific time frames and significant events gives you a much deeper understanding of the prevailing trends relative to those important starting points.
Okay, so AVWAP brings together price, time, and volume. Let's dig into why each of those is so critical. The book starts by saying price is the most important. Why is that the foundation?
The author's argument is that price is always generating new information. Every single trade, every tiny price movement reflects the ongoing tug of war between buyers and sellers. Plus, price acts as both a result of market forces and a cause for further reactions.
And then there's time. It's not just about what price something reaches, but also when it reaches that price and how long it stays there.
Exactly. Time gives us perspective on how trends develop and how long they last. The book stresses the importance of looking at multiple time frames. What might look like a significant drop on a short-term chart could just be a minor dip within a larger, longer-term upward trend. Think of it like looking at a map. You need different levels of zoom to see both the local roads and the major highways.
And volume. We often hear that volume needs to confirm what price is doing. What's the book's take on the role of volume in all of this?
The book agrees with that. It points out that healthy, sustainable market moves usually have increasing volume in the direction of the main trend, and lighter volume when the price moves against the trend. This suggests that the dominant move has, conviction behind it. However, a crucial point the book makes is that volume always comes second to price. Price creates the new information. Volume tells you how many people are participating in that new reality.
Interesting. It's interesting, too, that the book mentions how intraday volume often has a U-shaped pattern, typically higher in the morning and again towards the end of the trading day. That's something you see pretty consistently.
Yes, that's a common intraday characteristic. You often see more institutional activity at the open and close. And to show you how broadly applicable these ideas are, the book even mentions that Warren Buffett reportedly uses VWAP in his analysis.
Wow, really?
Which is a surprising name for some folks to hear in this context.
It really is. And there's also that example in the book about Southwest Airlines selling a big chunk of their stock.
Yeah.
And how that average selling price then acted as a resistance level for the stock. That's a really clear, real-world example of institutional VWAP in action.
It is. While the book doesn't go into the, nitty-gritty of all the specific ways big institutions and algorithms use VWAP and AVWAP, these tools are definitely used by those larger players to help them execute big trades without causing huge price swings and to identify potential areas where other big players might be active.
Okay. Moving on to how our own biases can affect our trading. The book touches on this idea of anchoring from psychology, and it's a bit different from the AVWAP anchor we've been talking about.
That's right. Market sentiment is basically the overall feeling or attitude of investors towards a particular stock or the market as a whole. Understanding sentiment is vital because, as the book reminds us, markets aren't always driven by pure logic. Now, the psychological concept of anchoring is our tendency to latch on to the first piece of information we get when we're making decisions. In trading, this could mean getting fixated on a price something traded at in the past, even if the current market situation has completely changed.
So how does AVWAP, this tool we're learning about, help us deal with this natural human tendency to get, anchored to irrelevant information?
Well, AVWAP provides a dynamic, data-driven anchor point that's based on actual price and volume traded since a specific point in time that you choose. It helps traders move away from just remembering arbitrary past prices and instead focuses their attention on a volume-weighted perspective that's tied to a significant market event or time frame.
Okay.
And the book makes it clear that unlike the standard daily VWAP, you can anchor AVWAP from practically any point on the chart, making it a much more flexible way to establish a relevant benchmark.
Let's dig a little deeper into the AVWAP itself. We know it averages price and volume starting from that anchor point. What are some key ways to think about how price interacts with this line?
One really useful idea the book introduces is thinking about price relative to the AVWAP as a way to gauge the trend's health. For instance, it talks about the concept of guilty until proven innocent, when the price is trading below a declining AVWAP, suggesting the downtrend is likely to continue until there's strong evidence to the contrary. Conversely, when the price is above a rising AVWAP, it's more like innocent until proven guilty, implying the uptrend is likely to persist. This gives you a framework for how to interpret price action around the AVWAP.
So the AVWAP almost sets a sort of expectation or benchmark from that specific starting point.
Exactly. And the book visually shows how the AVWAP calculation starts with that very first candle at your chosen anchor point. Also, keep in mind that an AVWAP on a 1-minute chart is going to react much more quickly to price changes than an AVWAP on a 5-minute chart, as the book illustrates. The time frame you're looking at matters.
Now, where do you typically choose to anchor your AVWAP from? The book mentions several common starting points.
Yes. Some of the most frequently used anchor points are the open, the high, the low, or the close of a particular price bar. The author even suggests that taking the average of the open, high, low, and close, often referred to as OHLC4, can be a really comprehensive choice because it takes more of the price information into account for that starting point.
And how does AVWAP really differ in its behavior from something like a traditional moving average that a lot of people use?
That's a critical distinction. Unlike simple moving averages, AVWAP gives a much heavier weighting to volume.
Right.
What this means in practical terms is that if you see a big surge in trading volume, the AVWAP line is going to react to that much more quickly than a simple moving average would. It's more sensitive to the intensity of trading activity around that initial anchor point.
Okay.
The book even has a comparison that visually shows the subtle but important differences between simple moving averages, volume-weighted moving averages, and AVWAP, highlighting that while they might sometimes look similar on a chart, their underlying calculations and how they respond to trading were quite different.
Makes sense.
The book also briefly mentions things like standard deviation bands around the AVWAP, which can give you an idea of how far price is deviating from the volume-weighted average, but it doesn't go into a lot of detail on those in these sections.
Okay, we've got a solid understanding of the foundations now. Let's move into the second part of the book. Actually putting AVWAP to use in our trading. One of the first things it points out is that these core ideas about trends in AVWAP aren't just limited to one type of market or one time frame.
That's a key takeaway. The author explains that because price charts tend to show similar patterns across different timescales, that's what's meant by the fractal nature of charts.
Right.
The basic principles of identifying the trend and using AVWAP to analyze it can be applied whether you're trading stocks, commodities, currencies, or even cryptocurrencies.
Yeah.
And whether you're looking at a chart of minute-by-minute price changes or daily price movements.
The book also acknowledges that there's a degree of subjectivity when it comes to choosing where to anchor your AVWAP. Does that make the tool less reliable?
Well, while it's true that different traders might have their own reasons for choosing different anchor points, the author remains a strong believer in the fundamental power of AVWAP as an analytical tool. That very subjectivity allows traders to really tailor their analysis to their specific trading strategies and the timeframes they're focused on,
Right.
letting them concentrate on the starting points that they believe are most relevant for their analysis.
What about when the regular trading day is over and we're looking at extended hours trading? The book has a brief word of caution there.
Yes, the book advises being cautious when trading during extended hours due to the fact that there's often less trading volume, which can lead to bigger and faster price swings.
Lower liquidity, yeah.
Exactly. It specifically warns against making emotional trading decisions during these times when liquidity might be thin, and recommends using smaller position sizes if you do trade outside the regular market hours.
Good advice. Now let's get down to the practical applications. How can we use AVWAP to help us decide when to get into a trade and when to get out?
One of the main ways is to recognize that AVWAP can frequently act as what's called dynamic support in an uptrend, where the AVWAP line itself is moving upwards. You can see examples of this in the book. Conversely, in a downtrend where the AVWAP is declining, it can often act as dynamic resistance, potentially preventing the price from moving much higher.
So if we're in an uptrend and the price pulls back down to that rising AVWAP, that could be a potential spot to buy, anticipating that the AVWAP will act like a floor and the price will bounce back up.
Exactly. And the reverse is true in a downtrend. If the price rallies up to that falling AVWAP, it could be an opportunity to initiate a short position, expecting the AVWAP to act as a ceiling. The direction and the slope of the AVWAP line are really key indicators of who's in control.
Okay.
A downward sloping AVWAP suggests sellers have the upper hand. An upward sloping one indicates buyers are dominant. And if the AVWAP is relatively flat, it suggests a period of more balanced or sideways price action.
That slope really does seem important. It's not just about whether the price is above or below the line, but which way that line is actually pointing.
Precisely. The steeper the slope, the more conviction is likely behind the buyers or the sellers. The book also points out that in a downtrend, the price might briefly pop above declining AVWAP before the downtrend continues, so you have to be careful not to jump to conclusions too quickly.
Right, a little overshoot.
Yeah.
Yeah.
And frequent crossing back and forth above and below the AVWAP can be a sign of indecision in the market.
Okay. The book outlines a couple of specific ways to use AVWAP for entering trades. Buy the touch and enter with momentum. Can you walk us through those?
Sure. Buy the touch, as the name suggests, involves entering a long position when the price pulls back and touches a rising AVWAP, with the expectation that it will bounce off that level and continue upwards. However, the book does caution that not every pullback will result in a bounce, so it's crucial to have risk management in place. Enter with momentum is a slightly more conservative approach. For buying, it means waiting for the price to actually bounce away from the AVWAP before you enter a long position. Similarly, for shorting, you'd wait for the price to move away from the AVWAP after touching it from below. This approach waits for some initial confirmation that the AVWAP is indeed acting as support or resistance.
Okay,
Yeah.
That makes sense, waiting for confirmation. Now, let's get back to the crucial step of choosing where to actually set that anchor point. The book covers quite a few different possibilities.
Yes, the choice of where you anchor your AVWAP is really going to shape how you interpret the subsequent price action. As the book emphasizes, your analysis is always in relation to that starting point. One important category is anchoring to high-volume events.
Okay.
For example, if you see a breakout to new highs on significant volume in an uptrend, that high-volume bar can be a very informative anchor. Similarly, a breakdown below a key support level on high volume in a downtrend can also be a significant anchor point. These events often indicate a real shift in market sentiment.
That makes sense. A surge in volume during a breakout or breakdown suggests that there's genuine conviction behind that price move. What other kinds of events might make good anchor points?
Measurable news-driven events like earnings announcements or statements from the Federal Reserve are also often good candidates for anchors.
Ah, okay.
These events tend to create significant price volatility and can establish new trends, making the price level immediately after the event a logical starting point for your AVWAP analysis.
So we're generally looking for events that cause a noticeable reaction in both price and volume.
Exactly. The book also suggests anchoring to important price-based or technical levels, such as significant swing highs and swing lows. These points represent turning points in the market's recent history and can provide valuable context when you're analyzing price action with AVWAP.
And then we have time-based anchors. Those seem pretty straightforward.
Yes, these are quite common. Anchoring your AVWAP to the very start of the trading week, creating a week-to-date AVWAP, the beginning of the month, month-to-date, the start of a new quarter, or even the beginning of the year, year-to-date AVWAP, can give you a really useful perspective on the trends that have developed over those specific time periods.
The book also introduces these concepts called the AVWAP handoff and the AVWAP pinch. They sound like more advanced techniques.
They are a bit. The AVWAP handoff typically happens within an established uptrend. You anchor one AVWAP to an earlier swing low, and then as the uptrend continues, a new higher swing low forms. You can then anchor a new AVWAP to this higher low. This handoff can signal that the original uptrend is actually accelerating as new buyers are stepping in at higher average prices.
Interesting. Acceleration.
Yeah. The AVWAP pinch occurs when the price action becomes compressed between AVWAPs anchored from different starting points. This often represents a buildup of potential energy.
So the pinch is like a market in a tight holding pattern, waiting to break out.
Precisely. As the book explains, a pinch often forms when the price is trading between an AVWAP that's anchored to a longer-term trend and another AVWAP anchored to a more recent shorter-term move. The idea is that the ideal time to consider a trade is when the price finally breaks out of this tight range, especially if that breakout is in the direction of the underlying primary trend.
Got it.
The book advises waiting for that actual break before taking action.
Okay. The outline also mentions using AVWAP for gap trading, identifying potential short squeezes, and even for trading initial public offerings.
Right.
Although we didn't get into those specific details in these excerpts, it sounds like AVWAP has a lot of different applications.
That's right. The book does dedicate separate sections to exploring how AVWAP can be specifically applied in those various trading scenarios, highlighting its versatility as an analytical tool beyond just basic trend identification.
Finally, let's talk about how AVWAP can help us identify those crucial levels of support and resistance that traders are always looking for. This feels like a natural extension of everything we've been discussing.
Absolutely. The book explains that AVWAP can act as a dynamic form of support and resistance. Unlike traditional horizontal support and resistance levels that are based on past price reactions at specific price points.
Yeah, static levels.
AVWAP support and resistance levels are constantly adjusting because the average price calculation is always being updated with each new trade from the anchor point.
So in an uptrend, that rising AVWAP isn't just showing us the average price where people have been buying. It's also a potential level where buyers might be likely to step in again if the price dips down to it.
Exactly. And in a downtrend, that declining AVWAP often acts as a ceiling, a level of resistance where sellers might be inclined to add to their positions if the price rallies up towards it. What's particularly interesting is how these roles can sometimes reverse.
Oh.
The book illustrates how an AVWAP level that previously acted as support can, once broken, then start to act as resistance on subsequent rallies, and vice versa.
It's like these levels have a memory. Once the price breaks through them, their function can flip. Role reversal.
That really ties into the psychological aspect of support and resistance. The book refers to them as levels of interest. Traders remember these price areas where the market previously found buying or selling pressure, and that past behavior can influence how they react when the price revisits those areas again.
Makes sense.
However, a really important point the book makes is that the more times an AVWAP support or resistance level gets tested, the higher the probability that it will eventually fail.
That makes logical sense. Each time it's tested, the supplier demand at that level is potentially getting, absorbed or used up.
Precisely. Wears it down over time.
Well, this has truly been a deep dive into the concepts of volume-weighted average price and especially anchored VWAP, all thanks to the detailed insights from Brian Shannon's book. It's clear that AVWAP offers a really powerful and adaptable way to analyze market trends by looking at the key ingredients of price, time, and volume, all starting from significant points that you get to choose.
Yes, its dynamic nature and its ability to be tailored to different time frames and important market events provide a really unique perspective on understanding potential support and resistance areas and getting a better sense of whether buyers or sellers are truly in control of the price action since those key anchor points.
So for you, our listener, here's a final thought to consider. Think about how you could start incorporating AVWAP into your own analysis. Try experimenting with anchoring it to different significant events in the assets you're following, maybe after a big earnings announcement or at the start of a major price move.
Mm-hmm.
Could this reveal hidden levels of support and resistance that traditional methods might not show you? Could it give you a clearer picture of who's really driving the trend beyond what simple price charts might suggest?
Yeah.
It's definitely something worth exploring further in your own trading. Thanks for joining us on this deep dive.